Welcome to this third and final video on business KPIs, at least for now, for beginners and small business owners. The KPIs we will cover today will help you further grow your business. And if you quickly want to know which KPIs they are, be sure to check the description box below. Not only do we have timestamps so you can quickly and easily scroll through the video, we also have links to the entire masterclass covering everything. We also have the ebook, which is totally free, which covers all the KPIs from this entire series. And we have videos to the previous videos in the series that I made. Finally, there's also a calculator or spreadsheet down in the description box below, where you can simply fill in the figures of your business and all the KPIs will be calculated automatically and you don't have a headache. They will help you identify which part of your business requires your attention and which ones you can focus on to grow your business. You may wonder why I created this series and this video. My name is Jim Bauman, and my mission in life is to help you turn your passion into a sustainable source of income, achievement, and fulfillment. The other day, I was talking with one of my clients who has recently started his own business, and I realized that he doesn't really know what KPIs are and how you use them to grow your business. So to help him and other people like him who want to start a business or who started a business but are stuck and don't know how to grow, I created this series covering all these KPIs. As I mentioned earlier, links to all the resources are down in the description box below, as are timestamps in case you want to quickly scroll through the video. Without further ado, let's start today's section. Now I will move on to section number 3, which is business KPIs for beginners and small businesses, covering the KPIs you should know to grow your business. If any of this seems unfamiliar, be sure to check the previous sections or the previous videos by checking the description box below, where you can find all the timestamps and links to earlier videos and sections. Today we will cover only a few KPIs, but we will cover some bonus formulas that can quickly help you grow your business. To start off with our barbershop, we will keep the figures the same as we used in the previous section. The number of customers we have at the start of the month is 100, meaning about 100 customers are coming to our business on average every month. During this month, we acquired 50 new customers, but we lost 10 of our old loyal customers. The number of new customers that came to us via referral, via word of mouth, or an introduction from somebody else is 12. By knowing these figures, we can calculate our retention rate and our referral rate. Retention rate means the percentage of customers that we had before that came back to purchase again. It's basically the opposite of the churn rate. If you're unfamiliar with the churn rate, be sure to check the previous section or previous video by clicking on the timestamps or the video link in the description box below. So you can calculate it in two ways. Either you take the 100% minus the churn rate, or you calculate it by taking your current customers minus the customers you lost, which is 100 minus 10 equals 90, and dividing that by the customers you started with, which is 100, leaving you with a 90% retention rate. Again, you're basically looking at the same thing as a churn rate, except from a different perspective. The referral rate shows you the percentage of your customers this month that came via a referral or an introduction. The way we calculate that is by taking the number of referred customers, which is 12 for our barbershop, and dividing that by the total customers we ended the month with. Since we haven't calculated that yet, we do that for our barbershop by starting with our 100 customers at the start of the month, adding 15 customers that we acquired during the month, and then deducting the 10 customers that we lost, showing that we have a total of 105 customers at the end of the month. 12 divided by 105 equals 11.4% or 0.114. There are different ways in which we can acquire new customers. Of course, we can do it via paid advertising like Google or Facebook. We can do it by using social media, such as TikTok, Instagram, Line, Facebook. We can also have an email list. These are like digital ways. Then offline, you again can do it via advertising, for instance, flyers or billboards. But we can also do it via word of mouth and referrals. And all of the methods I mentioned so far is basically a linear increase. So if we spend $1 in each of these, we will be able to calculate how much we get as a return. If we spend $2, we will probably just double the return we get. But referrals or word of mouth is basically free marketing and free advertising. And the way we get that is by having a product or a service that provides more value to the customer than what he's paying for. If the customer really appreciates your product and service, and he thinks that he got a bargain, that he spent less than what he actually received in value, he is more likely to refer this business to a friend. Some people try to have campaigns or set up campaigns with their business where they incentivize their loyal customers to refer their business to their friends. Of course, that's a good way to start, but know that if your product or service is so good that customers will introduce your business to their friends by themselves without you doing anything, you basically don't have to spend any money or incentivize anybody to do it. So knowing your referral rate, if it's a very low figure, let's say less than 1%, then you know that the value you're providing to your customers is not high enough for them to actually talk with their friends about you. So what you would want to focus on is providing even more value, really understanding the needs of your customers and resolving or solving as many of the pain points that your customer has to make them feel like they really got a lot that was worth their money. If you want to know more about this, be sure to leave a comment below. If anything is unclear, be sure to leave a comment below and I will make a specific video about that. Right now, I simply want to let you know about the KPIs. Also in the ebook, for which you can find the link in the description box below, I mentioned more about the referral rate and the retention rate. Moving on to startup capital and return on investment. Most businesses start with some money already. In the case of our barbershop, we invested $50,000 to start this business. Some of that money got spent to acquiring a location or paying rent or renovating or buying equipment. So some of that money we might not have anymore. But we started a business with $50,000. As we calculated in the first section or in our first video about KPIs, which you can find in the description box below, our business is making $300 net profit at the end of the month. On an annual basis, if we don't improve or reduce the performance of our business, on an annual basis, we will earn about $3,600 in net profit. This allows us to calculate the return on investment by taking the net profit on a monthly or an annual basis and dividing that by the total amount of money we invested in the business when we started. So as you can see, our barbershop is earning 7.2% as a return on our investment by taking the $3,600 annually in annual net profit and dividing that by the $50,000 in startup capital. As I mentioned, we could calculate this in months or in years or in any other time period as well, simply by changing how we calculate the net profit. When you simply look at the 7.2%, you might think, what does this exactly mean? It helps you in two ways. The first way is it helps you calculate how long you should keep this business running before you have earned back all your money. In the case of the barbershop, by taking the $50,000 it cost us in startup capital and dividing that by our annual net profit of $3,600, we can see it will take us about 14 years before we've earned back all of our startup capital. This doesn't mean that we have lost our startup capital. It simply means that after 14 years, we can take out the $50,000 of our business again because we no longer need that money since we have earned that same amount of money during that time. Another way to calculate it is by dividing 100% by the percentage of your return on investment. So 100 divided by 7.2 shows you exactly the same result of 14 years. The second way in which return on investment is a useful figure is if you're comparing adding new services or products in your business, or before you start a business or a new project, and you want to calculate which one is worth my money and my time. So what I mentioned so far in the previous slide is more looking at historical return on investment by using data that you got in the past. The one I'm going to talk about now is doing a forecast. to try and figure out what you expect to get in the future before you invest any money or time, and see which of these 2 or 3 things that you are comparing is worth your time. To show an example with our barbershop, we are thinking of adding 2 new services. We have shaving for men and we have perms for women. The cost to implement the shaving for men is $12,000. This could be training fees, getting new equipment, maybe hiring staff, whatever comes with introducing this new service equals $12,000. For the perms, this equals $15,000. If you think very simply, you would think the shaving for men is a better investment because it actually costs less. But this is where return on investment really shows its power, more so compared to the costs. In our example, we introduced shaving for men 2 years ago, so we have 2 years worth of data. And we know that after 2 years, we had a net profit of $20,000 by introducing the shaving for men. We introduced the perms for women last year, so we only have 1 year worth of data. And in that 1 year, we also earned $20,000 worth of net profit. Again, if you do a simple calculation, you will think the perms for women cost 15 and it earned us 20. So we made a $5,000 net profit. And the shaving for men earned us 20,000 and it cost us 12,000. So it earned us 8,000 in net profit. Again, this probably means that the shaving for men was worth our time and investment more. But as you can see from the return on investment, this is not the case. We calculate the return on investment, as I mentioned in the previous slide, by taking the net profit and dividing that by what it costs us to invest, which is the cost to set up these new services. The shaving return on investment is 167%. The perms return on investment is 133%. However, the shaving return on investment is based on 2 years, while the perms is based on 1 year. So to make sure that we are comparing apples with apples and not apples with oranges, we divide the shaving ROI by 2, so that we can see on an annual basis, on a yearly basis, the return was 83.5%. Now you can see clearly that it would have been worth more time and money to introduce the perms rather than the shaving. You might think, how can I use this for my own business? Right now, we use it based on data that we had in the past, but you can also make a forecast by talking with other business owners in your industry, or by talking with suppliers from whom you're trying to get the equipment. You can get information and forecast, make a prediction on how much revenue you will be able to earn, what the cost will be, and what your gross and net profit will be for that service. It might take a day or a week of talking with different people and trying to get information from different sources so that you can make a well-educated guess, a calculated guess, or an assumption to see how much you will be able to earn. But think about it this way: by only spending a day or a month or a week in advance of making these quick calculations and figuring out the ROI, you can quickly see, is this a profitable endeavor or not? And how much time would it take me to earn back my investment? Finally, I want to move on to 2 extra formulas, one being the golden ratio and one being the client finance acquisition. Again, if you look these up on Google, you probably won't find much, because these are names that I found from another person, that I learned from another person. So I'm using the same phrasing he used, but it's not something like common knowledge. If these are unclear, be sure to check the ebook, which is in the description box below, and you can read everything in a more simple manner. But what these mean: the golden ratio is basically a ratio that you achieve when your referral rate is higher than your churn rate. I made a quick example where the referral rate is 11.4% and the churn rate is 10%. When you reach this referral rate being higher than the churn rate, it means that without spending any money on marketing, because customers are referring you to their friends or to other people, and you're getting new customers that way, which is all free word-of-mouth marketing. And at the same time, the number of customers that are leaving you is lower than the number of customers you are getting every time from referrals and introductions. Your growth is basically infinite, because you are acquiring more customers for free compared to the customers you lose. That's why we call this the golden ratio, because you basically have gold in your hand, and all you have to do is simply keep going and keep doing business the way you are doing. The last formula I want to introduce to you is what we call client finance acquisition. The way we calculate this is 2 times your cost of acquisition, and your cost of goods sold should be smaller than your 30-day cash. We are mentioning cash and not revenue because it's very important for this type of acquisition, because it means that for each customer, what it costs us to acquire a customer is half the price of what we get from that customer. To give you simple examples, you can see 2 times a cost of acquisition of $5 and a cost of goods sold of $15 equals $40. But our 30-day cash of what we get from that customer is only $30. On the other hand, we can have a $3 cost of acquisition and an $11.50 cost of goods sold, which when we double that is $29, which is lower than the value that we get from each customer of $30. As I mentioned at the bottom of the slide, the income and cash of each new customer pays for itself and for the next customer. You might still think, how does that exactly work? If we take that first example, it costs us $20 to acquire a customer, and we are only getting $30 back. We spent 20, which means we're at minus 20. We get 30 back, which means we are plus 10. But in order to acquire the next customer, the second customer, we would need $20 and not 10. So the first customer would put us at minus 20. Then we would get 30 from him, which is plus 10. And then we would spend 20 again, which puts us at minus 10. So as you can see, because we go to minus and minus, we would every time have to invest some money. And over time, it's still a profitable return because we get $30 back for every $20 we spend. But in the beginning, we would have to invest some money. On the other hand, in the second example, you can see it only costs us $14.50 to acquire a customer. So when we acquire him, it's at minus $14.50. When we get money, which is $30 from that customer, it puts us at plus $15.50, which leaves us with more than enough to acquire the next customer, because the next customer only costs $14.50, which puts us at a plus $1. All of this might seem still a bit unclear, so if it is, I suggest you to download the ebook and read it through at your own pace, or to rewatch this section, or finally to use the calculator where I calculate most of the KPIs. Clients finance acquisition is not something that you need to necessarily worry about for your business. These 2 formulas, both the golden ratio and the client finance acquisition, are simply ways that if you are able to achieve them with your business, you will be able to grow and scale very quickly and exponentially. Thank you for watching this final episode of the Business KPI series that I've made, at least for now. If anything seemed unclear, be sure to check all the links in the description box below, which has not only the ebook or the previous videos or the entire masterclass or the calculator spreadsheet that should help you quickly fill in some figures from your business and get all the KPIs automatically calculated. If anything still seems unclear, be sure to leave a comment below, and I will either reply in the comment box, create more content, or create more resources to help you further understand and grow your business. If everything was really nice, you really liked it, be sure to give the video a thumbs up, subscribe to the channel so that more people can find this video via YouTube. If you know some people personally who could really benefit from this knowledge and this information, please share the link with them. And I hope that it proves beneficial to them as it did to you. My name is Jim, and I hope to see you in the next video.